Thank you very much, ladies and gentlemen. Thank you, Jeremy, and thanks also to Nick Williams for inviting me to speak at this conference this morning. I've changed the title of my presentation a little bit this morning. I am going to be focusing on gold. And, if you've heard me speak before, if you've read any of my work on the Internet, or if you've read my book, The Coming Collapse of the Dollar, you know that I'm a gold bull. So the logical question is, why invite a gold bull to a silver conference? And the reason is, I think Nick knows that I'm more bullish on silver than I am on gold. And I think the other reason why I've been invited to speak this morning is I look at silver from an entirely different perspective. My analysis on gold is that gold is money, and I look at gold from that particular perspective. And in order to understand silver, I think you have to first understand gold. And what I'll be doing this morning is explain a little bit of the logic as to how I view the markets, how I view gold, and how I therefore view silver, and as well as explain what some of my expectations are going forward from here. So I've entitled my presentation, Key Factors in Silver's Bull Market. And in order to look at gold, I'd like to start with this chart. This is a price of crude oil. This is a chart of crude oil prices going back to 1945. And, when we calculate or look at prices of crude oil in terms of various national currencies, we know that the price of crude oil is going up, regardless of what's happened over the past couple of months. Now, what I'm going to show you here is a chart of crude oil prices in terms of four different currencies. The first currency here is the British pound, and this is a base 100 analysis. If you're not familiar with the base 100 analysis, it assumes that the price of crude oil in all four currencies was 100 in December of 1945, and then it calculates the percentage changes going forward in these four different currencies, and able to facilitate a very easy and clear comparison between the performance of these four different currencies. So this is the price of crude oil in terms of the British pound, and this is the price of crude oil in terms of the dollar. You can see that the price of crude oil is rising in terms of both currencies, but you can also make another conclusion from just comparing these two different currencies. As bad as it's been for the U.S. dollar since the Second World War, sterling has been even worse in terms of inflation and loss of purchasing power. I'd like to now look at the price of crude oil in terms of a third currency, and that's gold. And you're going to have to look very closely at the very bottom of the chart. You can't hardly even see any fluctuations in the price of gold. And the reason is that an ounce of gold still buys today essentially the same amount of crude oil it did 50, 40, 60 years ago. This is why gold is money. It's very useful in economic calculation. And I sort of like to give you what I call my bullionist theory of money in order to put this particular relationship in perspective. Why does gold have this consistency in purchasing power? Well, it's really very simple. All of the things that we humans produce, all of the commodities that we produce are essentially produced for consumption. Soybeans are consumed, crude oil is consumed. But gold is different. It's not consumed. It's accumulated. Or in the popular terminology, people say it's hoarded, but I like to call it's saved. There's an old Chinese saying, wisdom begins by calling things by their right name. So if gold is money, you don't really hoard it, you really save it. And it's accumulated because gold really doesn't have any use in other applications. Sure, there's a small amount used in dentistry and a small amount used in electronics. But the amounts used, and even a small amount used in adornment jewelry, as opposed to monetary jewelry, which is the reason why most jewelry is acquired, gold jewelry is acquired in Asia, South Asia, and in the Gulf. It's acquired because gold is money. It just happens to be fabricated into a form in which ladies can wear it, so they get the dual benefit of adornment as well as the monetary aspects that gold jewelry conveys. But gold is money; it's saved, and the entire above-ground stock of gold has been saved since the beginning of time. It's this cube, approximately 20 meters square, which is approximately the bottom 1/5 of the Washington Monument, if you want to visualize essentially, the size of this cube of gold. It's gold mined from, ancient times up to the present. It doesn't disappear, it doesn't go away. but it has usefulness because we can use it in economic calculation. We can use it in order to measure prices over long periods of time. And the example that I like to use is that when Sir Isaac Newton invented the classical gold standard in 1700, a pound had the same purchasing power in 1914 as it did 200 years before, when looking at the purchasing power of the pound compared to a variety of different commodity baskets. There was a wonderful book written by an American professor, by Roy Jastrom, approximately 25 years ago, called The Golden Constant. And he analyzed 500 years of British monetary history. And this consistency of gold's purchasing power is there. Because, again, gold is accumulated. Now, not only is it accumulated, but this above-ground stock is added to by about 1.75% per annum. And that's approximately equal to world population growth and new wealth creation. So you have this consistency over long periods of time in terms of gold's purchasing power. Now, we talk about gold being very volatile, but as you look at this chart, you can see it's not that gold is volatile, it's that national currencies are volatile. Because over the long haul, gold maintains its purchasing power. Gold is money. But interestingly, not only is gold money, but silver is money too. You can see silver goes basically horizontal along this bottom of the chart as well. Now, what I'm going to do is I'm going to take this chart, which is a linear scale. I'm going to put it on this next chart, the exact same numbers, but it's going to be a log scale so that we can better see the actual relationships. Now, the beauty of a log scale, if you're not familiar with it, is that it's very easy to compare relative performance, because the movement on this chart from 100 to 300 is the exact same distance as it is from 1,000 to 3,000 or 10,000 to 30,000. So it's very easy to make relative comparison performances. And you can see how the price of crude oil in terms of gold, the pound and dollars has risen, while the price of crude oil in terms of gold and silver has remained relatively constant. But you do get fluctuations between gold and silver, and this is the gold-silver ratio. Now, what the gold-silver ratio basically does, it shows over long periods of time how many ounces of silver are needed to purchase an ounce of gold. And this chart goes back to the mid-1970s, and you can see in 1980, it was 16 ounces of silver to buy 1 ounce of gold. Back in the early 1990s, it was 100 ounces of silver to buy 1 ounce of gold. The question is, well, why does this ratio occur? Why do we get this fluctuation? And again, this goes back to my Bullionist theory of money. And I have to bring a little economics into the equation here, unfortunately. But in economics, you have different types of demand. You have what's called elastic demand, and you have inelastic demand. Inelastic demand means you want something regardless of the price. And elastic demand means that you're very sensitive to changes in the price. And what we're seeing here is that it's demand that drives the gold-silver ratio. And let me put this into perspective. I'm not a geologist, but the geologists who know this tell me that there's approximately 10 times more silver in the Earth's crust than there is gold. So one would logically think, well, silver should be 10 times more expensive. Gold should be 10 times more expensive than silver, just based on these supply considerations. And the miners tell me that approximately 8 times more silver is produced every year than gold is produced. So one would think that silver should be 1/8 of the cost of gold, or gold should be 8 times more costly than silver. But you can see that by looking only at the supply side of the equation, you're missing the big picture, because it doesn't take 8 or 10 ounces of silver to buy 1 ounce of gold. It presently takes 74 ounces of silver to buy 1 ounce of gold. And last week it took 80 ounces of silver to buy 1 ounce of gold. So it's demand that really drives not only gold, but it's also demand that drives silver. And going back to this elastic and inelastic demand, the answer to this ratio is that the demand for gold is very inelastic. People want it regardless of the price. Silver, on the other hand, has a very elastic demand. People are very sensitive to changes in price with regard to silver. So what happens is, in precious metals bull markets, the ratio falls, because on the margin, the money coming into the sector has a bigger impact because of the difference of demand types between the two metals. It has a bigger impact dollar for dollar or pound for pound on silver than it does for gold. Conversely, in precious metal bear markets, when money is leaving the sector, it also has a bigger impact on silver. So what you see happen in precious metal bear markets is the ratio rises, and then in precious metal bull markets, the ratio comes down. Now, basically, we're going sideways. We were declining until a few weeks ago when this ratio went from in the 50s all the way up to 80. But you can see that we've maintained this essential trading range, and I think we're probably at the end of this particular moment in the trading history of silver. What we've seen over the past couple of months has been, the word's been used a lot, but it really, I think, does apply, unprecedented events. We've had a massive deleveraging, and look at a couple of currencies to explain that. There had been a carry trade between the yen and the Australian dollar, for example. A lot of hedge funds were borrowing Japanese yen